Something is shifting again, and it's happening quietly, not loudly, not dramatically, but in a way that usually comes before something bigger moves. Just a few sessions ago, silver didn't just dip. It dropped sharply to around $76.41 in a single move, one of the steepest declines in recent weeks. And now, it's hovering right above that same level. That's not random, that's not noise, that's structure forming. Because at the same time, market data shows silver trading around $77 to $78 range. Just this week, analysts are openly pointing towards $75 as a critical breakdown level, and global macro pressure is rising again, not falling. So the real question is no longer, where is silver right now? The real question is the market already pulling it towards $76 before Friday closes? And if it is, then this isn't just a price move, it's a signal. Because right now, everything that drives silver is starting to align again. Let's slow this down, because if you just look at the chart, you'll miss what's actually happening. Silver hasn't been moving in isolation. It has been reacting to a chain reaction happening across the global system. And that chain reaction just restarted. Oil prices pushed above $100, again due to Middle East tensions. Inflation expectations are rising again globally, and central banks are being forced to respond carefully. Now this matters because silver doesn't move only on demand. It moves on macro pressure. And right now, macro pressure is building again. The International Monetary Fund, IMF, recently warned that global inflation could rise modestly again in 2026, especially if energy prices remain elevated. At the same time, they also revised growth expectations lower, which creates a dangerous mix: slower growth, higher inflation. This is what economists call stagflation pressure. And historically, this type of environment creates volatility spikes across commodities. But here's where it gets uncomfortable, because silver doesn't always benefit immediately from inflation. In fact, when inflation rises too fast, central banks often respond by keeping interest rates higher for longer, and that changes everything. Because this isn't just about inflation, it's about liquidity. Liquidity is the fuel of markets. And right now, that fuel is tightening. Let's talk about something most people overlook: why interest rates matter so much for silver. Silver doesn't pay interest. It doesn't generate yield. So when rates go higher, investors shift capital toward assets that do. That's not theory. That's how capital flows work. Right now, markets are adjusting expectations around the Federal Reserve. And the signal is clear. Rate cuts are becoming less certain. Why? Because inflation risks are rising again, driven by energy supply disruptions, geopolitical instability, stronger dollar movements. Recent data shows the US dollar has strengthened again due to safe haven demand. Treasury yields have also remained elevated, and historically, higher yields increase the opportunity cost of holding metals, meaning silver becomes less attractive in the short term. This is why, even though silver is considered a long-term store of value, it can still fall sharply in the short term. And this is exactly what we are seeing right now. But here's what most people are not asking. If silver has strong long-term demand, why does the market keep pushing it back towards $76? Because the answer is not demand. The answer is timing. If you're starting to see what's happening here, subscribe to the channel, like the video, and comment your view, because this is one of those moments where understanding the setup matters more than reacting to headlines. Now let's zoom out. Because silver's story didn't start this week. Earlier this year, silver surged aggressively, reaching record highs above $110, driven by strong investment demand, industrial demand, especially solar and tech sectors, and uncertainty around global monetary policy. But what happened next? The market corrected hard. Silver is now down more than 30% from its January highs. And that correction was not random. It was driven by stronger dollar, higher interest rate expectations, and fading short-term liquidity. But here's the important part. Long-term fundamentals have not disappeared. According to industry data, the silver market is expected to remain in a structural deficit for the sixth consecutive year in 2026, meaning demand still exceeds supply. Physical inventories are tightening, and long-term pressure is still building. So now we have a contradiction. Long-term bullish, short-term pressure. And when that happens, markets enter what professionals call compression phases. This is where price gets squeezed between opposing forces. And historically, compression phases don't last forever. They resolve. So now the real question becomes, is $76 just a level or the center of a much bigger move? Now imagine this. It's Friday. Markets are open. Silver is moving slowly, not aggressively, not panicking. But every time it tries to move higher, it gets pushed back, controlled, measured. Almost like large players are adjusting positions quietly. Price drifts, $78, $77, $76, and this is where traders start watching closely, because this zone is not just support, it's a decision zone. Above it, the market stabilizes. Below it, things can accelerate quickly, and analysts are already warning that $75 could trigger a larger move if broken. Don't ignore this moment. Subscribe, like the video, and comment what you think happens next. Because once the move starts, most people will only understand it after it's already over. So let's connect everything clearly. Silver recently dropped sharply to approximately $76. Key support sits just below inflation. Risks are rising again. Central banks are staying cautious. Liquidity is tightening. And now, price is drifting back toward that exact level again. Now, that's not coincidence. That's positioning. And when positioning forms like this, the next move is rarely small. So the real question is not, will silver touch $76? The real question is, what happens after it does? Because if this level breaks, the reaction may already be in motion. And right now, the market may already know something that most people don't. Something is building again, but not where most people are looking. Not in the headlines, not in the price charts. It's happening inside the system itself. And if you step back for just a moment, you start to notice something strange. Silver is not falling randomly. It is reacting. Because right now, multiple forces are pressing on the market at the same time. And those forces are getting stronger. Let's start with what just happened. Over the last few sessions, silver didn't just dip. It dropped sharply again toward the $75 to $76 zone, hitting multi-week lows. At the same time, oil surged above $100. The US dollar strengthened and inflation fears came back into focus. That combination is not random. That combination is dangerous because when energy prices rise, inflation pressure increases. And when inflation pressure increases, central banks hesitate to cut rates. This is where everything changes. Let's slow this down because this is where the real signal is hiding. According to the latest IMF outlook, April 2026, global inflation is expected to rise modestly again this year, while economic growth slows at the same time. This is not a normal environment. This is what economists call a fragile macro cycle, where growth is slowing, prices are rising, and policy options become limited. And in this type of environment, markets become extremely sensitive. Silver is one of the first assets to react. But here's what should really get your attention. Silver is falling, even while global risk is rising. That's not how a traditional safe haven behaves, because silver is not just a safe haven. It's something more complex. It sits between industrial demand, investment speculation, and macro liquidity. And right now, liquidity is tightening again. Let's talk about this clearly, because this is where most investors lose the plot. When central banks like the Federal Reserve keep rates high, money becomes expensive. When money becomes expensive, liquidity shrinks. And when liquidity shrinks, risk assets and commodities often struggle. This is not theory. This is historical behavior. Recent market reactions confirm this. Precious metals dropped as yields stayed elevated, silver fell alongside gold, despite geopolitical tension, and investor sentiment turned cautious again. That tells you something important. The market is not reacting emotionally. It is reacting structurally. So ask yourself this: if silver is still in a long-term supply deficit, why is price repeatedly pulled back into the same zone? Because the answer is not supply. It's timing and liquidity cycles. Now let's go deeper, because this isn't just about silver. This is about a chain reaction happening globally. Right now, the Middle East situation is unstable. Oil supply routes like the Strait of Hormuz are under pressure. Energy costs are rising. And according to global energy analysts, disruptions in that region can push inflation higher globally. This matters more than most people realize, because energy drives inflation, and inflation drives central bank decisions, and central bank decisions drive liquidity, and liquidity controls everything. Listen carefully. This is not just about price. This is about the system adjusting. If you're following this level of detail, subscribe to the channel, like the video, and comment your view, because this is not surface level analysis. This is how real market positioning is understood. Now let's bring this back to silver itself, because the chart is telling a story, but only if you know how to read it. Silver right now is trapped between long-term bullish fundamentals and short-term macro pressure. On one side, the silver market is still in a structural deficit. Demand continues to exceed supply for multiple years. On the other side, the Federal Reserve remains cautious. Inflation risks are rising again, and yields are staying elevated. This creates tension, and when tension builds in markets, price compresses. This is exactly what we're seeing. So now the real question becomes, is the $76 level just support, or the center of a much larger move being prepared? Now imagine this moment. It's late in the trading session. Volume is slowing. Traders are watching key levels. Silver moves slightly higher, but doesn't break resistance. Then slowly, it starts drifting down again. No panic, no headlines, no sudden crash, just pressure, controlled, measured. And that's when experienced traders start paying attention, because this type of movement often happens when larger players are positioning quietly. And where does price keep moving? Towards $76 again. Now let's bring this forward, because timing is everything here. If silver closes near this zone again, it creates a weak weekly structure. And historically, when metals close weak near support, the next session can become highly volatile. And this is happening right before the weekend, which means news can shift sentiment, geopolitical events can escalate, and markets reopen with gaps. We've seen this before, and when it happens, the move is rarely small. Don't ignore this moment. Subscribe, like the video, and comment your prediction, because once Monday opens, the opportunity to react early may already be gone. So let's connect everything again. Silver recently dropped to approximately $75 to $76. Oil prices surged above $100. Inflation fears are rising again. IMF warns of slowing growth plus rising inflation. Central banks remain cautious. Liquidity is tightening. And now, price is slowly drifting back into the same zone. That's not coincidence. That's pressure building. And when pressure builds like this, the release is rarely controlled. So the real question is not, will silver touch $76 again? The real question is, what happens when the market finally reacts to everything at once? Because if this pressure breaks, the move that follows may not wait for confirmation. And right now, that moment may be closer than most people think. Right now, the market is not calm. It just looks calm because underneath the surface, pressure is building from every direction at once. Over the last few sessions, silver didn't just move, it dropped towards $75.9, then rebounded slightly, then hovered again near $77 to $78. That type of movement is not random. That's instability. And here's what makes this moment different. Because this time, the pressure is not coming from one source, it's coming from everything at once. Let's break this down clearly. Because this is where everything connects. Right now, oil is above $100. Inflation expectations are rising again. Central banks are staying cautious, and the US dollar remains strong. This combination historically creates volatility in metals, not stability. Even recent analysis shows silver has already fallen over 30% from its January highs and is now trading in a compressed range between $76 and $81. That tells you something important. The market is not trending. It's preparing. Because when markets stop trending, they usually start deciding. Now let's talk about the one factor controlling everything: monetary policy. According to recent institutional expectations, the Federal Reserve may keep rates higher for longer due to persistent inflation risks. And this matters more than anything else, because when rates stay elevated, liquidity tightens, borrowing becomes expensive and speculative, positioning gets reduced. That's exactly what silver is reacting to. Even the IMF's April 2026 outlook suggests inflation may remain elevated in the near term while economic growth slows slightly. That combination creates uncertainty, and uncertainty creates volatility. But here's the real question. If inflation is rising, why isn't silver moving higher right now? Because timing matters more than direction. Now imagine this scenario, not from a retail perspective, but from a professional one. Large institutions are not reacting emotionally, they are positioning. Right now, they are watching interest rate expectations, oil price movements, dollar strength, and geopolitical developments. And instead of chasing price, they wait. Because in volatile environments, entering at the wrong time matters more than entering at all. This is why the market feels slow. It's not inactive, it's calculating. If you're understanding this level of market behavior, subscribe to the channel, like the video, and comment your view, because this is not surface level noise. This is how real capital moves. Now let's move forward, because timing is everything here. Imagine this. It's Monday morning. Markets reopen. Over the weekend, oil remains volatile, headlines continue. Inflation concerns stay elevated, and the market reacts. Silver opens. If sentiment weakens, it breaks below $75. And suddenly, stop-loss orders trigger momentum traders, react, volatility spikes, and within hours, the move accelerates. Now imagine the opposite. Silver holds $76, stabilizes, and then buyers step in. Because historically, strong support zones can trigger rebounds. But here's the key point. Both scenarios are possible, and that's exactly what makes this moment dangerous. So now ask yourself this. Is the market preparing for a breakdown or quietly positioning for a reversal? Because the answer is not obvious. Let's connect everything clearly one last time. Silver dropped sharply towards $76. Recently, key support sits just below at $75. Oil prices surged above $100. Inflation risks are rising again. The Federal Reserve may delay rate cuts. The IMF signals slower growth plus persistent inflation. Liquidity is tightening. And now, price is hovering right at the center of that pressure. That's not random, that's convergence. Don't ignore this moment. Subscribe, like this video, and comment your prediction, because once the move happens, the market won't wait for confirmation. So now we come back to the original question, not will silver close at $76, but what happens after it does? Because history shows something very clear. When markets compress like this, they don't stay quiet. They expand fast. And when they do, most people don't react in time because they're still waiting for confirmation. But the market doesn't wait. And right now, everything is aligning again. Not perfectly, not predictably, but in a way that suggests something is about to move. And the only question left is, will you see it before it happens, or only understand it after it's already too late?